Julian McCormack, one of Platinum's investment specialists, will provide a December quarterly update for the Platinum International Fund. Julian, can we start with an overview of the changes that have taken place in markets over the last year?
To answer that question, think about what the world felt like in January last year. So oil had just halved, Europe had gone negative rates, Japan had gone negative rates. Every industrial input was miserable, everything was oversupplied. We were in a deflationary world. Now think about how the world feels. All of those industrial inputs have changed. They've all bottomed. Some have bounced pretty well. So zinc in particular, and energy's really changed. You know, oil prices in the mid-50s. This is quite a different world. Also, every single long bond rate is well off its lows. So everywhere across Europe, Japan, and the US, you know, you're appreciably higher than where you've been. So we're now in a mildly inflationary world. Now, what's the significance of that? You just want to be very careful of defensive exposures and safety. Be careful of the tricks that have worked for the last 8 years.
So where do we see the US at present?
The US at present is expensive relative to its own history and to opportunities elsewhere. It looks somewhat expensive on earnings, but we really must think about where the earnings come from. So on price to book, price to sales, US companies are very, very expensive. I mean, to put that into some context, on a 10-year average PE, this market's on 28 times. We've seen this twice before in its history. Once was 2000, once was 1929. Not great times to buy stocks. But we must be careful. So bull markets tend not to die of old age. They die of a fever. There's every chance you get a nice little rally here, and that could be a real sucker punch for investors.
And then what are the main points of interest for the year ahead?
In the year ahead, we've got a mildly inflationary environment with reasonable global growth. So we've escaped the deflationary spiral of the post-crisis repair phase, and now we're actually growing. So one really wants to be careful of duration, so interest rate sensitive exposures. Be very careful of very high PE, expensive growers, which are sort of a play on duration. As interest rates go up, the discount rate goes up and they might become somewhat less attractive. And you do want to look at assets that have cyclicality and will benefit from a growth environment. Now, what do I mean specifically? In our portfolio, we've got Chinese consumers, consumer exposures, we've got Indian infrastructure and European banks. And they'd be great examples of that kind of asset.
So you just mentioned Europe. Should we be worried about geopolitical risk there?
From the outset, we should say we pay very close attention to and are concerned about political risk and the potential for any form of banking crisis. But let's just put that in context. Try to think about what the world was like in the 1980s. So you had ETA in Spain blowing people up. You had the IRA in Ireland blowing people up. You had the Red Brigades in Germany blowing people up. Now we seem to be equating referenda and elections with political risk. That's pretty strange. So this seems pretty catastrophized to us. These are democratic processes and they're messy, and we might see very significant change going forward in the structure of the European Union, but we don't actually think that will interrupt what is a pretty healthy recovery from a very deep, very protracted recession.
And what about the European banks?
So as regards potential for a banking crisis, it's pretty clear what fixed interest markets are telling us. There is very little systemic stress going on here. So if we look at Euro LIBOR, so interbank offer interest markets, they are functioning very, very well. We can look at credit default swaps on the banking exposures that we have. Similarly, they're not telling us anything is awry. Now, this is the exact reverse of what happened in 2007, 2008. So in that period, the equity market was complacent and the fixed interest market was telling you the world was over. This is the complete reverse of that scenario. So once again, we're being somewhat catastrophizing about these issues. There are problems, but those problems are actually being dealt with by a responsible regulator. Deutsche Bank maybe does have to raise some capital. Monte dei Paschi maybe should go broke. But that's what a responsible regulator should do. It shouldn't bail everybody out. So there are problems, absolutely. But can we find an opportunity amidst that? That's not right.
So lastly, what's the outlook for Asia?
Asia's had an interesting 6 months where it's performed very well in the lead up to the US election and has sold off with the threat of Trump protectionism. We don't actually know what that protectionism will entail, but it is interesting that the US and Europe in part has responded positively to a Trump presidency, and Asia has responded negatively. There are reasons for that. It makes some sense. So a strong US dollar, that's an effective tightening. That might slow down trade and economic activity. That might hurt your Asian exposures. Similarly, the protectionism issue, that might hurt Asian exposures as well. But let's just think this through. What does it do for US corporate profitability to be taxing supply lines in Asia? It's bad for US corporate profitability. The S&P is more than half foreign earnings. And they're not investing in Asia because they're UNICEF. They're doing it to make money. So this, we think, actually presents interesting opportunities. This looks to us like a region that grows, that saves, and is cheap. It's cheap in parts. It's not all cheap. India is quite expensive. But there's unquestionably good opportunities there. So the Chinese consumer, once again, Indian infrastructure. Also, other economies are really strong. So Thailand is now growing at 4%. The Philippines is growing at 6.5%. It's just posted 8 monthly PMIs in a row over 55. Now, its president is something of a psychopath, but we shouldn't let that blind us to opportunity. This is a cheap and growing market. So Asia overall looks like a place that has a lot going for it.
Thank you, Julian. For the full written report from the fund's portfolio managers, Kerr Nielsen and Andrew Clifford, please visit our website.